Thanks so much for tuning in to Talking Point. I'm your host, Niraj Shah, and our guest today is Ravi Dharamshi of Value Quest. He needs no introduction, much sought after his views, and around new highs for the markets. It's always good to get good opinion. Ravi, value your time. Thank you so much for talking to us today.
Thanks, Niraj. Good to be here.
Yep. Ravi, what's your sense? The the opinion that I got on almost all the days that we were inching towards the new highs and post that was that, and you can sense it, that the indices are at highs, portfolios aren't. So people are a mixed lot. What's your sense around the landscape as we are where we are?
Oh, yeah, absolutely. I think, first of all, I think India has done a fantastic job. And when I say India, I'm talking about economy as well as the markets. We are definitely very fortunate to be around the highs. But having said that, I think below the surface, this is only an indices and a very narrow market that is making highs. There is some amount of all other market participants, whether it is the mid cap investors or traders and all, the momentum is missing in the market, and the usual euphoria that is around new highs is definitely not there. So but that is a good thing. I look at it as a good thing because usually a euphoric high is something that scares you. Basically, that means the prices are not very, very attractive. I think we are biding our time. So we have had $35 billion of outflow, and maybe $4-5 billion have come back, but the nature of the money that is coming in, the color of the money that is coming in has changed. I think a lot of the hedge fund and momentum money has gone out. What is coming now is the long only sovereign pension, that kind of money is coming. So that is a good thing for the market. But that is a very discerning investor. They'll buy only when they see value.
Mm. So, Ravi, what do you sense the uh, large private investors like yourselves are doing? I mean, anyone with northwards of $500 million of AUM, what's happening in that bucket currently? Fully invested, a bit cautious, parking themselves in defensives. What's your sense? What are you doing as well?
Yeah, no. So as I mentioned earlier, this is a very narrow market, and only indices are making new highs. So the usually the 10,000 to 50-60,000 crore kind of a market cap is the space that we usually operate in, and that is definitely a little bit challenging right now. So the valuation had gotten a little ahead of themselves, and then there is some correction. But see, I think largely, if I were to give you a broad view, the India's profit cycle is still expanding. India's earnings cycle in the last couple of quarters, or there is a pause, or there is a little bit of a downgrade because there is hit on the margins, whether it is raw material cost, freight cost, everything is hitting. But at the same time, growth is not a challenge. We are seeing everywhere. Almost all companies are seeing order books which are full. They have the confidence to invest for in their future. So growth is not a challenge. Margins are a little bit of challenge. Balance sheet are absolutely spick and span. So there is no problem at all. So one of our biggest reason why we stay bullish in this market is because the balance sheet are not a problem at all. Indian corporate balance sheet has never been so strong and healthy. So we are an OSS in the world. So if it were not for the global headwinds, we would probably be witnessing much stronger Indian markets. But having said that, we have to deal with cards that we have been we have to work with the deal cards that we are dealt, and right now it looks like a middling kind of a thing where opportunities are there in some spaces and not in some.
Yeah, because but Ravi, I presume that the hypothesis would be that this margin challenge is but a temporary one in nature, simply because I mean, yes, we are at the mercy of what's happening on geopolitics, but at some point of time, it'll probably show some signs of uh, relenting.
Yeah, if I were to actually gaze out a few quarters, I feel the margin issues are already behind us. Freight rates are down, commodities are down, crude has also come off. So many things are pointing to the fact that inflation itself is going to be down, and interest rates, the pace of interest rate hike has definitely peaked. Whether we'll still get some rate hikes, of course, but I think India does not need to follow the US Fed, where the challenge is quite different. Whether it the inflation they are witnessing is very different from what we are going through. Our food and fuel led inflation is actually cooling off. So, and we need to be supportive of growth. So I wouldn't be surprised if RBI at some point charts its own course. So yes, these margin issues are temporary. Inflation issues are also temporary for us, and I think market is waiting for one of those triggers. So maybe 2-3 quarters down the line, this margin issue, in fact, margins will start expanding. So we need to see the operating leverage kick in the overall corporate world. Our utilization levels are around 73-75%. Once this inches towards 80%, you will see that whatever hit they took on the gross margins is actually compensated by increase on the EBITDA margins because of the increase in utilization. So we will definitely see it's a 1-2 quarter phenomenon, not more.
And you reckon this OPLEV correction of sorts starts happening for the domestic-led firms first? Because currently the street is firmly divided amongst whether or not to go in for the export-oriented firms at all, or in some cases people are saying that, hey, we like the pricing because the pricing is baking in the pain on the export side. Which camp are you in?
So clearly, value investors, for them, they might be a little early, but the opportunity has started emerging in the IT and pharma or the exporters as such, where they have taken a hit. Valuations have become much more attractive, but I feel the pain over there is going to last a little bit longer. I guess better time, a little bit 10-20% kind of further valuation correction and a couple of quarters more down the line would be a better opportunity is what I feel. But because again, same thing, valuations are attractive over there. The domestic story is now well known. It is well identified. The business momentum remains strong. So I don't see a reason for the valuations to correct. But at the same time, there is nothing which is available almost, at a throwaway valuation or any such thing. It is a challenge. If you're looking for growth at reasonable valuations, very few companies are falling in that space.
Yeah, Ravi. So because you have a large portfolio, I want to understand what is the current bent of the portfolio of domestic oriented versus the export, and the new money that you might be investing, or whether if you book something out and put in, is that going in the same proportion or is it going in a slightly different proportion?
No, so 90% of our portfolio is oriented towards domestic, and within that, financials, manufacturing, uh, consumer, and some little bit of real estate and ancillaries are the areas that we are focusing on. We basically we have been invested in that, so the old portfolio definitely stays invested over there. New money that is coming in also we are distributing in that proportion only. We are not. Yet deploying more money just because the value has emerged. We like to see triggers emerge, catalysts emerge for the value to get discovered, and that is we are just waiting on that. So at this juncture, we are not changing our portfolio strategy too much from what it was.
Okay. Can I pick up on one or two of these things and talk about them? So, for example, consumers. I mean, yesterday was the big FMCG day. We spoke to Parley earlier in the week, uh, wherein the management said that they've already started seeing the pickup at the rural end, and probably very few companies know about this as good as Parley does, right? Because of this, of their kind of distribution that they have. What's your sense? I mean, was that a flash in the pan relief move of sorts in FMCG and the likes, or do you reckon that it's time that the markets will now start pricing in a bit of a rural recovery for all things consumption?
So on the margin, there is definitely a recovery in the rural markets, and that should pan out. And relatively, the FMCG had become slightly more attractive. I won't say on an absolute basis they are very attractive or something, but the consumer staples are usually the defensive markets are kind of looking at as a hiding place where incrementally things are not going to get worse, but things are going to get better. Overall for us consumption is a very very large space, and FMCG is actually not the space that excites us. We are actually more excited about maybe footwear retail, maybe apparel retail, maybe QSR food retail. Those are the areas that excite us the most. Of course, some amount of post COVID revenge recovery is happening over here, so one has to be a little careful in extrapolating the current strong numbers into the future. But at the same time, these are the business models that have a long runway, and if you have a company that has actually cracked the model, they are getting outpriced pretty soon, but they will continue to stay elevated as long as there is no emergence of competition. So you will not find the scale. What we are talking about is very, very small. Some of the largest retail chain we have is 1,500 stores in a country like India. I mean, US, for example, the Domino's is like 8,000 stores, and we can easily reach a 4-5,000 stores kind of a number for the largest retail chain. And some of the other ones also, now slowly we are seeing there are more number of retail chains which are between 300 and 700 kind of store range. So the real scale is getting built, real inflection point is reaching for some of these businesses where economics are there. Now it's time to actually let the operating leverage work and focus on the margins, and that is the space that really excites us.
That's pretty interesting. So, a couple of follow-ups here, Ravi. We spoke to some such companies, and they're fitting right into the points that you mentioned. So, for example, we had a chat with a company called Metro Brands. I mean, I'm not trying to talk about that individual name because I don't even know whether you have a view on that or not. But my question is this: that here's a company which is saying that we are growing at a good pace organically. They've added some inorganic moves, and they project fairly strong growth rates going into the future. The problem is the starting point on valuations. Now, my question to you is therefore that are you as an investor comfortable with some of these names if they are trading at much higher valuations because the runway for growth is large, and as you said, the store count is still a fraction of what it ideally could be?
So you're absolutely right. Valuation is something that always remains challenging. But I'll tell you how the framework that we use to think about it. See, the valuations are not in a silo. It is not only about that company in the entire scheme of things. You have to look at the industry growth cycle as well. You have to look at the company's life stage also. So, for example, if some of these companies have reached 300 odd stores, now the cash flows that they are generating itself is allowing them to add 40-50 stores on their own without taking any leverage or anything. So the machine starts working on its own. Until then they had to really take some leverage, or they were constrained by their own balance sheet size to expand any further. So now the models have really fallen in place where they can go from pathway from 300 stores to 600-700 stores can happen in a very quick pace and from their own balance sheet. So in this kind of a sweet spot, these companies usually get overvalued, and from an absolute point of view, there is still money to be made, is what I feel. But it takes some amount of convincing to make an entry at these levels.
Got it. Again, on okay, so okay, fine. We can go on, but the paucity of time. So let me move topics. Thanks for the view on consumption. I already got your view on some of the export-oriented themes like IT. But Ravi, I can't not ask you about two pockets which are kind of correlated to each other and facing a bit of stress right now, which is pharma as well as specialty chemicals. Great year until 2021, then suddenly you've fallen off the cliff, so to say, maybe for the right reasons. What's your sense here? Because I see that you've done some shopping recently on the spec chem side, at least. The ValueQuest name has come up in some of these deals. How are you thinking about these two pockets?
So our overall view on the specialty chemicals still remains that one has to be careful over here. The valuations are on the higher side. It is see, on the back of a 6-7 year fantastic wealth creation journey in chemical space, one can expect a 2-3 year kind of a period where no great wealth is generated. But having said that, the story on the chemical side remains very attractive from a 5-year point of view. And if you have the ability and willingness to withstand the next 1-2 years where there might not be too much of wealth creation, there are still some gems to be discovered. The China plus one and Europe plus one is a reality. We are witnessing a lot of companies get a lot of business interest, RFPs. So some of these RFPs to convert into business can take a little longer than expected. But our biggest concern in the specialty chemical last 1 year was the margins, because the pricing for some of the finished products had gone through the roof, and of course there was going to be a pressure on the margins because the spread had narrowed. The raw material prices also went through the roof, freight costs also went through the roof. So that is now normalizing. So will and some amount of valuation normalization has also happened. So we have started kind of nibbling back in, but still, as I said, we are mentally prepared that for a year or so there might not be much of returns. So coming to the second part of your thing of pharma, pharma I think is facing structural challenges, and I'm talking about specifically about US facing generic business. There is a lot of pricing pressure. The But the valuation on pharma has really probably reached very close to rock bottom. So from that point of view, it could be a space to look at, but I am not yet seeing any kind of catalyst emerge for that value to start correcting itself. So the buyers have consolidated in US. The suppliers are still competing against themselves, cutting prices. So the way we look at the whole pharma space is that oral solid or US facing oral solid generic manufacturers are going to witness a problem. So we have to see their scheme of things, whether this piece, as it keeps becoming smaller and smaller, then it will stop mattering in their overall scheme of things. If the contribution to the profits is falling less than 20-25%, then I think even though US piece does not remain still attractive, the overall numbers will start changing again. Indian domestic pharma continues to do well, but it is also priced very well. It is not available cheap. So we have to find other niches like rest of the world, emerging markets, or some specialty therapeutic area like inhalers, complex generics. So those are the areas which will give these companies an ability to generate profits slightly higher than what they are doing right now. So again, you have to see the life cycle of each company. Where do they fit in? Have they made that journey? Are they beyond the adjustment? If that is the case, then I think valuations have become very attractive in pharma.
Got it. But you'd probably go out and shop in the US facing generics only once they
You have to be
become much
selective.
smaller. The
Yeah,
trigger
you
is
have to
not
be
really reached yet.
selective about what. It's not a.
Got it.
You cannot take a homogeneous call in pharma like IT. Pharma is a very heterogeneous space. Every company is in a different cycle.
Got it.
So it requires a stock picking ability rather than taking a broad call.
My final question: you mentioned that you have exposure to financials. While the while it's a bit of a no-brainer of sorts, what I'm trying to understand is, have you as well, because I know how choosy you are per se, have you as well been tempted to take some positions in the PSU side? Because a lot of people have, and the last 2 months have turned out really well. I'm just trying to understand, where are you on that topic?
No, I think there is absolutely no doubt that there was a lot of value over there. And when things improve on the margin, there are going to be stock returns. But our mandate and our philosophy, we will not look at this space very easily. So yeah, there are some changes that government is doing, like the MD of the company can now actually stay for longer. Those kind of changes are needed. See, we need interests aligned. For the largest shareholder over here is government, and if as long as they don't have a social objective but they have a capitalistic objective, and also there is somebody at the helm who can focus, whose interest is also aligned in creating that value, then only we will invest for a long term wealth creation. Otherwise they remain tactical bets from time to time, and in the cycle right now they're still attractive enough for to generate absolute returns. There is no doubt about that.
Got it.
But we are not deploying any capital over there.
Okay, great. Thanks, Ravi. Always a pleasure talking to you. Thank you so much for your time today as well, and wishing you a great 2023, because I reckon we'll now talk once the new year sets in. So all the best for that.
Thank you.
And viewers, thanks for tuning into this edition of The Talking Point.